The first assumption is the entity assumption. The entity assumption says that the owner is different from the organization that is being owned. So if you own your own company, you are a different accounting entity as compared to the company that you own. That's important because transactions between owners and the entity are very common. So if you don't treat the owner as separate from the entity, there is no way for you to account for the transactions between the owner and the entity. So it is very important. So if you are an owner of a company, and let us say you simply take the money from the company's bank account and buy groceries for your house, that will not be an expense for the company. It will just be treated like you paid yourself a dividend. And then what you do with that money is not the entity's concern. So even though you have full rights to take the company's money and do whatever you want with it, how the company accounts for it is very important. On the other hand, if you take your own personal money and let us say you buy some furniture for the company. Now the company has to treat it, if you don't get it reimbursed back from the company has to treat it like you donated money. Like you donated money. So it will be like a donation of furniture or donation of an asset to the firm by you. Okay, so therefore the distinction between the owner of the firm and the firm itself is extremely important in accounting. Okay. The second assumption is the time assumption, the time period assumption. Okay. The time period assumption says that all accounting activity can be divided into some distinct time periods. So therefore, if you say, okay, you can prepare an income statement for the year, you can prepare a balance sheet as of a point in time. So time is critical in all of the accounting rules. So any activity of the business can be artificially divided. I mean, the whole accounting of the business is artificially divided into different time periods so that you can measure performance. So you can actually answer the question, how much profits did this company make last year? Okay, how much was my total cash flow last year? So therefore, the time period assumption is very important. The third important, and I'm only listing the important ones, not everything. The third important assumption is the monetary unit assumption. The monetary unit assumption is actually pretty simple. It says that every transaction that is to be recorded in accounting can be recorded in a monetary unit, like a US dollar or a Japanese yen, okay, or whichever currency that you're talking about. So there, and well, while we know reality is different, most accounting rules will assume that the currency is typically stable. If the currency is known to be unstable, then accountants will demand that you record all transactions using a stable currency. So that, when you are comparing performance across periods, you need to make sure that there is a certain amount of stability that existed between these multiple periods. So therefore, a monetary unit assumption runs through all of, the accounting, rules. Okay? The principles are very important. The first principle that we follow in the United States is what we call as the historical cost principle. The historical cost principle says that if you have a long-term asset that is recorded in the balance sheet at its historical cost or whatever you paid to procure that asset. So if you procure, let us say, a truck for your business, and let us say you paid, whatever, $30,000 for that truck. If you paid $30,000 for that truck, the truck is recorded in the books at $30,000, whatever you paid. Now, obviously the market value of the truck could be like $14,000 or $15,000 after 3 or 4 years. But the truck will still show in the books at $30,000. Let's say you buy land. You paid $50,000 for the land. But the land's market value may go up subsequent to your purchase. But the land will still be shown in your assets at the original price that you paid to procure the land. That's what is called as the historical cost principle. The historical cost principle is important because that is one point of difference between US GAAP and the International Financial Reporting Standards. If you follow the International Financial Reporting Standards, they give you the option, they don't require you, they give you the option of revaluing even all these long-term assets at their current market value. So you can actually do that, but not under US GAAP. So for the purpose of this course, you can't do it, because we follow US GAAP. So the historical cost principle is one thing that is an important principle. The second principle is the revenue recognition principle. And the matching and we have gone over this revenue recognition multiple times in this class. Okay? So the revenue recognition principle says that there are two conditions to be met for revenue to be recognized. The earning, and it is either realized or realizable. So when you say that, let's say somebody pays cash for an item they buy at Walmart. That's a case where Walmart has earned the revenue because they have delivered the item to the customer and they have already realized the money because the customer paid cash.
What's that say, I'm sorry?
Realizable.
Realizable.
Now, if let us say you are a large contractor and you are buying items in bulk from Home Depot, and you go to Home Depot, you place an order for a bunch of bulk items, and you go to Home Depot, place the order, you pick up the order. Now, and let us say you have negotiated with Home Depot, you're a large contractor, you buy everything from them, so you have negotiated with them that you get 3 months to pay. Now, Home Depot will call that revenue because they have earned it, they have delivered the items to you, but it is not realized, but it is realizable. Because under normal course of business, Home Depot expects you to pay the money. So that is a point about revenue being either earned and realized or earned and realizable. If any one of these two is not met, then you cannot call it revenue. Okay, we talked about airline tickets. Airline tickets, when they are sold by the airline to the customer, at that point it is not revenue. Why? Because they have not earned it. When will they earn it? When the customer actually flies. So until the point the customer flies, it is not revenue to the airline, it is a liability to the airline. It's called unearned revenue.
But isn't it realizable at that point when they purchased it?
Right.
No, it's already realized. Because they've already paid the money. You already paid the money when you bought the tickets.
So why
So
isn't
they
it
got the
realizable?
money. But they have not earned it. That's what I'm saying. They have to meet both the tests.
I thought it was either one.
You can't eat either. No, it's either one of these two.
Okay, okay.
Earning
Okay.
and
Okay.
either realized or realizable.
Okay.
Professor, quick question. Why would it be a liability if the airline is not paying anything?
Well, it's a liability because they have to provide the service to you. They are obligated to provide the service. They got to fly you.
Okay.
They took your money, so they got to fly you.
It would be a liability because of the other customers, not because of a customer that's not flying.
No, it's a
Because, for
liability.
example,
No, it's got nothing to do with the other customers. It's got to do with you. You pay
I
and
owe
you
you.
buy a ticket.
exactly.
So I am the airline.
So
So I have to
exactly.
fly you.
But let's say if the customer doesn't fly, then it's not a liability for you though.
No, but how would I know? When I sell you the ticket, how do I know that you're not going to fly?
But you have
But
to,
you already sold the ticket, so
Yeah.
he's saying you
So
shouldn't
the
So
provide
at that
service.
point, I am obligated to fly you.
exactly.
So
and
you
then-
may choose to not show up at the airport.
So why would it be a liability if the airline?
But I have to
understand what
record
you're
it now,
saying.
right?
The airline knows that it has to fly. The way I see it is, for example, it's a liability if let's say I have to fly. In order for me to fly, I have to fly 100 people. But then out of those 100 people, only 90 fly. So then I'm losing money because 10 people withdrew. Then it will be, that's how I see it as a liability.
No,
No,
you're
they already
you're
paid.
thinking a lot about this.
Even though they're not
Tax
flying.
rate.
The whole amount, you know what I'm saying?
No, I see your train of thought, I see your train of thought, but
That's their money.
no, but that has got nothing to do with the problem that we are talking about here. This is a strict accounting problem. Today there is a transaction between you and me. You are the customer, I am the airline. Okay, you pay me money. I have taken your money. And against that, I have promised you that I will fly you
Correct.
on such and such date on such and such a flight.
Correct.
How do I account for the money that I have received from you? I need to account for this. It's cash to me.
Yeah, you need to fly. Yeah.
No, that's not the way to account for it. You have to
you're
show me
talking about the
accounts.
accounting now.
Exactly. Now, back when,
It will be accounts receivable in a way.
why receivable? Are you already paid? Why is it still
Because you
receivable?
haven't, it hasn't been,
Hasn't been earned.
it hasn't been earned yet.
So how is it still receivable?
Because
Receivable
let's
means
say-
that the money has not come in yet. It's going to come later.
Isn't it effective after?
You have assets.
I already took your money. There is nothing more receivable in this case. So it cannot be receivable. It is cash.
Okay, okay.
So to me it is cash. My question is, what is the other side?
Because the way I'm thinking about it, this is where my confusion is. Because, for example, you mentioned Home Depot.
No, before you go there, you answer my question. Right now, you answer my question. What is the other side to this transaction? Where would you put the other side? It's an increase to my assets. My cash has gone up by the exact ticket amount that you have paid. How do I record the other side to this transaction?
You owe a service.
You're providing the service after, though. So you
But
would
you haven't yet, that's the point.
No, but let him answer where the other side is.
No,
What is the
I
other
got it.
side?
Then I guess it would be, you cannot do an expense because you haven't done it yet, so it would be a liability.
There you go. It's not that you cannot do an expense. It's you cannot do a revenue because you have not done it yet. Now let me contrast this with a second situation. You go to the airport, you are desperate, you have to fly right now. You go there, you pay cash at the counter and take that flight. Now that is what? A liability or what?
No, because you did it right, the airline is offering that service right away,
So you're already flying. So it's revenue. So it doesn't go to the liability route. So the airline does not have to record it as a liability and then call it revenue when you fly, because you are flying. It is like buying an item from Walmart and paying cash at the counter.
So you bought it and used it.
You bought it and used it immediately. So therefore it is revenue to the airline immediately. So those are the two things that I want you to contrast. How something, cash money received from a customer, is revenue to an airline immediately, versus when the money received is revenue at a subsequent point in time, and that timing difference is because the earning part is not finished.
Okay.
Now let me take your Home Depot question. We're about to go to Home Depot.
The example that I was, because for example, let's say I'm buying the airline ticket
Mhm.
and I'm buying with the credit card, so I'm not paying cash,
That's fine.
which is a Home Depot example. If
Mhm.
you're paying with the credit card, it's not realized yet, it's because that's another company that has to pay Home Depot. So that's what my confusion. So let's say if I buy the plane ticket with a credit card, then you still haven't received the money yet, because it wasn't a cash transaction.
Yes.
It was with a credit card.
Yeah.
So that's why I was saying it should be accounts receivable.
Wait, that's a good point. In that case,
The airline gets the money immediately, now you owe the credit card, that's something totally different.
no, even if the airline gets suppose the airline does not get
Not
the money.
immediately.
Supposing you're using your American Express card.
Correct.
Okay, look, I'm not marketing American Express.
But you were saying,
Okay, supposing you use,
You're walking out with the product.
stop overthinking.
go ahead, finish it. What were you saying?
I was saying because for Home Depot, although you are using a credit card, but you're walking out with the product immediately, just like you went to the cashier, paid for your plane ticket immediately and got on the plane.
And you met all the conditions when you did that.
So that's
Right.
and
No, but in your case, you can still argue that it is receivable, okay? The customer I'm the customer, let's say I'm coming to Home Depot, I pay for, no, sorry, the airline, okay, no, did I change the thing? You are the customer, I'm the airline. Okay, you are the customer, I'm the airline. You pay me with your American Express card, right? Now, it is still receivable to me because I have not received the money from American Express. But it is a receivable from American Express, not from you. So if you want to argue that I should call it unearned revenue, a liability, that's still a liability because I have not flown you.
Because you haven't, yes.
I have not flown. So it's still a liability on the liability side. On the asset side, instead of calling it cash, if you say that I must call it receivables, yes, that's fine, I agree with you. So I can put it in
That's what I was
receivables.
trying to say. I guess
Wow.
I confused the terminology when I said why it should be a liability. Because I thought, I was thinking of it should be accounts receivable if you're paying with the credit card. That was what I was trying.
Okay, so you got it right all along. So I was the one who missed it. I'm sorry.
No, it was a wording of the
Okay.
question. That's what I was, because I haven't paid cash, I'm paying with the credit card.
That's right.
So the credit card has the option of paying you or not. That's what I guess.
You are absolutely correct. In that case, yes. If the contract with American Express is that if a charge happens today,
You're overthinking.
American Express will pay you,
Overthinking.
after deducting
As
the
usual.
commission, they will pay you the money in 3 days, then technically it is a receivable for 3 days. Right? So I do not know how many firms actually deal with this. Sometimes they may not. They may just say, okay, it's an immediate thing in 3 days, so call it, cash right away because it goes into the bank. But typically they will not call it. They should call it receivables, at least until the point that the money comes into the bank account, in which case it will go out of receivables and the cash will go up.
Oh, I see.
Okay. But again, remember, that may be an expense there too, because the money that is paid in, maybe only 97% or 98% of the charge. Because American Express will deduct some money and pay you only the rest. So there will be an expense also involved when the money gets transferred from American Express to your bank account. Right? Alright, so we know about the revenue recognition principle, and there are multiple examples of revenue recognition. Either the earning is not done, or the money is neither realized nor realizable. There are some extreme cases where a sale happens, but it is neither realized nor realizable because the risk associated with those sales are very high. Typically with installment sales. With installment sales, the risk associated with those installment sales are extremely high. Typically customers who buy items on an installment basis, the accounting assumption is that based on historical trends, these monies are not collected, completely. So therefore, in installment sales, the accounting is a little different. The profits are actually deferred until the cash comes in. So there are some exceptions to this, and I'll talk about them later, the constraints part of it. Okay? So now number 3 is, of course, the matching principle. The matching principle says match expenses to revenues. Classic example of the application of matching principle, we've talked about it during boot camp, it is depreciation. The reason you charge depreciation is because you want to match all expenses with the revenues that were earned during a period of time. So the expenses also must pertain to the same period of time in which the revenue was earned. So define the period, count the revenues, then find all expenses that need to be matched against those revenues. So the matching principle is another very important principle in accounting. Okay. Then under constraints, you have some constraints. Okay. One important constraint is, of course, the materiality. The materiality constraint is often abused more than used correctly. Okay, an auditor will tell you whether the materiality constraint applies or not. But many companies will apply the materiality constraint pretty wrongly. The reason was, so example of materiality constraint. Let's say you have 10 different expense accounts. And out of the 10, only 2 constitute about 90% of the accounts, of the 90% of the total amount. So you have, let's say, a total of $100 in expenses, but items 1 and 2 is $80, and 3 to 10 are $20. But the total is $100. So what do? Do you list all the 10 items? You typically don't. What you will do is you will list the first and the second independently, and you will combine the rest into one item called miscellaneous expenses or other expenses. Why? Because it's not material enough to be listed separately. In fact, there may be items here which are just $1, half a dollar, whatever. So therefore, that's where the materiality comes in. Sometimes, it is not necessary. For example, another classic example of materiality comes in when you buy office supplies. Okay, if you are Microsoft, and let's say Microsoft is buying office supplies. Technically, when you buy office supplies, what should you do? You should call it supplies. It's an asset. Until it is used, it is still an asset. But if you are Microsoft and you are looking at your total expenses, how much will be office supply expenses in your total expenses? Very, very small. So if you are Microsoft, what you would do, probably when you buy office supplies, you would right away call it an expense. You won't call it an asset and then go and count, okay, how many pads we have, how many pens we have, and then say, okay, how much have we used? You don't go through all that stuff. As soon as the item is bought, it is an expense in accounting. That doesn't mean you're just, not having quantity or physical controls. You will still have physical controls. But the point about expensing versus calling it an asset is that sometimes it is material enough that it should be called an asset. Excuse me. So you cannot say, if Microsoft buys a building in Seattle, it cannot say, oh, you know what, I'm anyway going to use the building, so I'll call it an expense. You can't do that. Now it's a material thing. You have to call it an asset and you got to depreciate it. But if you're buying things like office supplies, you may be able to call it an expense right away. So materiality is an important constraint. And then of course, you have the cost-benefit constraint. The cost-benefit constraint simply says, when accountants make up rules, they have to be aware of the cost and the benefits of these rules. Sometimes, a rule which is imposed on companies, it costs the companies time and resources. So if the benefits are not, substantial, at least substantially more than the cost, then those rules have to be given up. Because what you gain by having those rules is not enough compared to what it costs companies to have those rules. So, but this argument will go on all the time. Every time accountants come and impose a rule, companies will generally be up in arms saying that this is too costly to implement, I've got to set aside people just to do this. They did that with Sarbanes-Oxley. Now everybody is living with Sarbanes-Oxley. It's not such a big deal anymore. But whenever you impose new rules on companies, this question typically comes up. The last constraint that I want to talk about, this is very important. It's called industry practices. So what you raised, the question that you raised about agriculture, that could come under this, where you have deviation from the general rules in order to say grant specific practices of an industry which are very widespread, so the general rules of accounting may not apply there. So it may come under that constraint, that under those constraints the rules for in agriculture would be probably different. In fact, there may even be rules for, let us say, sports teams. Because sports teams, when they have these mega stars that they get into contract, these stars are paid a lot of money and they are all committed. Those payments are committed for a long time. It is not like you can just fire somebody like that. Normally in businesses, you don't hire people like that. There is no commitment that you will keep the person for 10 years. What you do have is, of course, if you fire them for any reason before that time, you will pay a certain sum of money. But typically, so with sports teams, sports franchises, the accounting rules may be different. So there are examples. But the example that I want to talk about, with you, is the example of construction contracts, or what we call as long-term construction contracts. So, for example, Palmetto Highway. I moved to Miami in 2001. Construction in Palmetto has been going on since that time. Okay, it will continue. It will continue. Way back and gone. They will still be constructing on Palmetto. And so now, if you think about it, and let us say that you are a contractor and you have a contract to construct a certain stretch of the road, Okay, now you may not complete that stretch of the road for, let's say, 2 years, 3 years, right? So if you follow the technical definition of revenue recognition, then you cannot recognize any revenue until the road is finished. Because your contract says one stretch of road, maybe 3 months, 5 months, whatever that stretch is. Until those 5 months are finished, according to this, it's not earned. Okay, so now what do? As an investor, if you are trying to review, or if you are looking at the financial statements of these contractors, you are not going to be able to predict revenues in any even fashion because it's all over the place. So what you do is that the accountants have made concessions in cases of, let's say, long-term construction contracts where you can recognize revenue as long as you have a valid contract with a price specified. Okay, it's a signed contract, so therefore that money is going to come as long as you finish the work. Okay, so that's number one. And number two, you are making progress towards completion. So based on some estimated cost to complete, there is a serious calculation involved. We teach it in the undergraduate course in an intermediate level, but we don't usually do it in MBA, but we just talk about it. So based on progress towards completion, you can recognize revenue. So let us say that you have finished, let's say, 30% of the road this year. You can take 30% of the contract price and actually call it revenue. But you will have to reverse it if the contract goes into cost overruns, which will not be reimbursed. Those are exceptions. But the point is that you can recognize revenue even though the item under the technical definition of earning is not earned. That's a concession you give to certain specific industry practices. Sorry, question? Okay. So industry practices is an important constraint that accountants are really aware of. So long-term construction contracts, profits can be booked or profits can be recognized even though the revenue itself under a general definition of revenue recognition is still not earned. But you are making progress towards completion. Okay. All right. Yes, go ahead.
For materiality, just to
I'm listening. Go ahead.
regurgitate it back to you to make sure that I understood it correctly, it's like a petty expense. It's something that doesn't make it to have its own account, and that's it.
That's an example. The other example of materiality is calling something as an expense versus calling it as an asset. An item is an asset until it is used. That's a technical definition of an asset. But sometimes an asset, like paper and pencils, who's going to look at exactly when it was used? So since it is so small, you call it an expense as soon as it is purchased. That's another example of materiality. All right, so now let's go to the sample quizzes. Which one? No, because it's all accrual in this course.
Okay.
We're not going to do. I mean, we'll answer. I mean, see, the idea is that you understand the difference between cash and accrual, right? In a cash system, nothing is revenue until the cash is coming in, and nothing is an expense until the cash went out. So the cash system simply tracks cash flows. Accrual system is what we've been doing so far. That's it. Okay, now you can see here the amount of resources that are already there. There may be some lectures that I have recorded on video. I recorded it for the pure online classes that we sometimes have. So you can use them as a resource. Some of them are long because I take one example and I run through them. So you may want to just look at it selectively. And the selected solutions are there. meaning that from the book I have selected some exercises and I have provided complete solutions, for those exercises. So which means that you will know not just the right answer, you'll also know how to get the right answer. So what I would strongly recommend is that use these resources as much as you need them. And, yes.
So, that quiz is gonna be exactly how our quiz is gonna be.
Sorry?
That quiz that you give us, the sample, is gonna be exactly how the quiz is that we're gonna
It's not exactly.
Not like the same questions, but like
Yeah,
the
I mean,
format.
see, the only thing what I did in the sample quiz was, as much as possible, reflect the same level of difficulty as the regular quiz.
Okay.
So for example, if you look at your book, the book will have the so-called, I think end of chapter assessments. Those end of chapter assessments are very, very easy. But the sample quiz questions are a little bit more difficult than that, because I wanted to reflect to some level possible that it should reflect the actual level of difficulty on a quiz. Okay? So that's one thing. But you may get really lucky that a question on the sample quiz actually shows up when you take the quiz. So that is a possibility. I cannot rule it out. It may still happen. Okay. So let me take the sample quiz one. And by the way, every sample quiz has already got the answers at the end. Okay. So there are 20 questions here. All the 20 questions have answers. Okay. So let's run through the sample quiz one. Okay. The company's policy towards dividends and growth could best be determined by which of these statements? Balance sheet, income statement, retained earnings. Because dividends directly affect retained earnings. So the retained earnings statement is the one that will give you a pattern of how the profits are and how the dividends are. So growth in profits versus growth in dividends, if you want to compare, then you can see that clearly in the retained earnings statement. Which of the following is the best, definition of an internal user of accounting information? Remember, with accounting information, there are multiple people who want that information. So who would be the example of an internal user? Investors, creditors, labor unions, managers. Typically, anytime you see the word internal, it's usually the managers, those who are running the firm. They are the ones who are the internal people, and they demand accounting information to make better decisions themselves. So they would be the classic example of internal users. Net income will result in a time period when what? Assets exceed liabilities, assets exceed revenues, expenses exceed revenues, and revenues exceed expenses. The answer is D. So you have profits when revenues are more than expenses. Are we going all right? Yes. Any questions? All right. 5. If total liabilities increased by 4. Good. Look, in every class you need to have about 4 or 5 people at least who will keep me honest. So it's very important. And you do your job and got me, and you don't understand what we go through as academics. There are times when I present my research in front of my colleagues. I put the first slide out, which is the title of the paper, and then there are already 5 people on my throat saying that, okay, that title is inappropriate. That's not what you're doing.
Wow.
So by the time I get to slide number 2, I'm already, okay, half the time is gone. But we go through this back and forth on why the title is appropriate, why it is not appropriate, and then I ultimately, I have to say, okay, I'll think about this, what you're saying, probably, so we move on. So we are a very different breed. For us, so I'll never forget this instance in an MBA class. It was a very first one. I think it was even the boot camp. That's the first time the students are meeting me. So somebody asked a question. And I said, okay, so you're arguing that. I responded by saying you're arguing that Because that's the way we respond when somebody asks a question. Immediately the person got so defensive and said, oh, no, I'm not arguing at all. I said, it's okay to argue. There is no problem. This is academics. We live with argument. Okay? This is our bread and butter. So there is absolutely nothing is unhealthy about having an argument, on a matter of content. But at some point in time, we will come to a resolution to say, okay, we agree to disagree, like the debit credit rule. If you start arguing that why, when an asset increases, you should debit it, I have no answer. That's the way I have taught it all my life, and that's all there is. We just move on. That's the way every